Hello, everyone. Welcome to After Hours. Did not realize my audio wasn't on. Thank you so much for your patience. I'm one of your hosts, Tom Hartman. I'm joined by no one this week. It'll just be me for this All Hallows Eve. Um, Today's After Hours is brought to you by Blue Sky, the best in class prop firm that offers same day activation, daily payouts, and no max. We'll see more about that later. For now, let's take a look at what's moving markets this week. It's been an interesting week. It's been Fed week, right? We're here. The Fed came out, they cut 25 basis points, but we expected that, right? That was what the markets had telegraphed. That's what had been priced in, and the markets foreshadow what the Fed will do because the Fed does what the market says. Why? Because they're there in order to keep volatility down, prices stable, and not shake the boat. But the Fed pressers have become a lot more interesting as we've moved on, or since Trump has become president, because there's this whole issue of will Jerome Powell be replaced at the Fed? And so the questions come sharp, come hard, as if people think, hey, this might be our last time to ask Jerome Powell any serious questions when it comes to monetary policy when it's affected by the administration. Because you can imagine that if what'll happen here is that the Trump administration will get a foothold within the Fed and really move the direction of things, then both fiscal and monetary policy would be the same. And who knows what markets look like then. But before we get started on that and we take a look at the at what happened during the presser this week, I want to first touch on what we're seeing here with the dollar. So the US dollar, this has been a pretty interesting move we've had so far. It's been meteoric when it comes to the dollar moving up in its range, because you'd imagine that with all this easing that we're expecting, that we'd be seeing the dollar falling, but no, it's rising. And we know that the dollar rises, generally speaking, because of funding pressures. So here we have the dollar going up and to the right after its low on September 17th, which is the last Fed meeting, right? The last Fed meeting in September 17th, we had a big drop in the dollar. You know, the Fed was cutting for the first time. We're on an easing cycle. We'd expect a move up. We'd expect a move down, but that didn't happen. We've got to move up afterwards, and it's been up ever since, all the way to now, the October meeting. And so that generally speaks to liquidity constraints within the markets. That's money is not available to be spent, which is to be understood. We've been taking a look at the we've talked about over the last couple of weeks what's been going on in the funding markets, repo, stand-in facilities for the Fed, where the Fed transmits monetary policy in order to try to keep a floor and ceiling on interest rates for the short end, and that has not been going so well. All right, well. Not to worry. We don't have to worry so much because the Fed has this in hand. So let's take a quick look at my favorite part of the Fed presser this week, where Jerome Powell was asked about Fed cuts in December. All right. Alrighty, here it is.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor, I don't think, for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. we have one tool. It can't do both of those. It can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT?
All right. So here he's saying that the Fed cut in December should not be a foregone conclusion. In fact, far from it. That's important. He's trying to telegraph, he's forward guiding that we shouldn't take it for granted that rates will be cut, which is interesting because previously he was saying that the markets do the job of letting us, of pricing in future cuts in order to ease conditions now. And now he's trying to walk that back at the same time as they're cutting rates.
How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Interesting. So QT is going to be stopping, at least in part. They're going to allow for balance sheet roll off. This is fascinating. It's fantastic. And it's fantastic if you want liquidity to be added to the markets. If you're not a fan of that, then this is not good news for you. All right. So that, as you might imagine, has had an effect on the dollar. One, they're saying that they're not starting QE right now. They're only doing lessening QT. And then they are saying that the Fed rate cuts in December are not a foregone conclusion. So who knows what that means for the rate cuts later on. So already we've had this issue over the last few months where the Fed has been waiting to cut rates and then they cut. And now they're saying, even though we're cutting, we're not going to cut as much. So it's no wonder that the dollar is moving up. Now, with the dollar moving up, normally we're expecting to see massive corrections or significant corrections within the stock market. And during this period of uncertainty, we've actually had two different things happening. First off, we have equities, the S&P and the NASDAQ, during this whole period of time doing all-time highs. Right, so we had all-time highs in these assets, and it's just been ramping up and ramping up and ramping up. So basically, since September, we've had a nice move up here. We've had a nice move up. lows. What is that? On the NASDAQ from the lows, we have a rise of about trough to peak 13%. We've had a little bit of pullback now. And then we had that whole fiasco where Trump tweeted out that because of the rare earth thing with China, there was going to be some tariff controls that are going to be put into place. But then since then, there's some jawboning from the Trump administration that's moved equities up, which has been pretty interesting, pretty fantastic move, pretty incredible move. If you're watching Price Action Live with Mike Christensen and myself, it's just been incredible. We would have expected to short constantly. We did try to short multiple times on the way up, but it turned out it just actually ripped. And now that the concerns have been eased some, we had a top that happened last week, and then now we're having a rollover, what looks to be a topping pattern, at least in the short term, on equities, which means this gap fill that we had here that was created on the 26th of October might get filled, which means we can see a drop of the NASDAQ down to the 25,500 level, and we could see a drop in the S&P down to the 6,823 level, at which point, I'd be looking to maybe not up the boat, but looking for some upside moves there. A nice healthy bounce. All right, so let's just go ahead and take a look here at what some of the people are saying as far as the liquidity concerns are concerned. I thought was interesting here as far as the TGA is concerned. So the Treasury General Account is the checking account for the federal government, and because we are in a government shutdown in the U.S., there's been a buildup inside of that account, and that money is part of what's draining liquidity from the markets, right? Because we have liquidity is the flow of dollars throughout the system, not just the added of new dollars, but the flow of dollars through the system. And wherever those dollars are being pooled or the credit is not being created, we have funding stress. So I love this post from London Crypto Club on X. Let's just read what he has to say. So he says, take a look at the Treasury General Account below. This is the chart down below here where it's moved up and to the right since the lows of July. Here he's talking about, especially as it relates to Bitcoin. So with the government shutdown, the TGA is not getting spent, so it's building as receipts are received and debt issued. So as bonds are being sold, that money is being stored inside of the TGA and not making its way into the broader economy or even financial markets. The latest opening balance stands at $965 billion, a build of circa $150 billion in October. That's cash coming out of markets. On top of that, into month end, the RRP is building as banks window dress balance sheets. The window dressing is when the financial institutions or companies do some shenanigans on their books, buy certain things, sell certain things to make their holdings look different than it did for the previous month. Generally to make the performance look better or to make it look like they're not missing the boat. So that's window dressing on balance sheets. The RRP is up circa 20 billion so far this week. That's all liquidity being taken out of this market. Add to that the fact that the bank reserves have fallen into the lower range of ample. This is creating some tightness in bank funding markets, witnessed by elevated SOFR spreads and rising usage of the Fed Standing Repo Facility, the SRF. Yesterday, eligible firms took just over $10 billion on loans from the SRF, a record since its introduction in 2021. Just in case you're not aware, the SRF is the facility that allows for entities to borrow money from the Fed, sell an assets, borrow money from the Fed with a guarantee of being able to buy those assets back later on. It's a way for them to get money. Whereas the reverse repo allows them to do the opposite. They're able to lend money to, or buy assets, and that the Fed the Fed does the opposite. The Fed gives them a premium on what they purchase, so they know they could sell it back at a gain, and they get a specific return on that. Because that return is guaranteed, that generally causes, it affects interest rates, because why go lend out money somewhere else for less if I can get this amount from the Fed guaranteed? So this reverse repo and the standard repo facility work in tandem with the Fed in order to keep interest rates, the short end of the curve for interest rates, pinned. Yesterday, eligible firms took just over $10 billion, the Post continues, on loans from the SRF, a record since its introduction in 2021. Whilst this is not extreme stress, it's tightening. This is why Bitcoin, given its super hyper sensitivity to liquidity, is failing to break out of the range. So what's changed? Obviously, after month end, an RRP will be drawn back down and return to that circa 20 billion to the market. Bank reserves will be more freely lent out too. Some tightness will remain until the end of QT on 1st December, but once that ends, we start to get Fed balance sheet expansion once more after a few years of contraction. The government shutdown ending likely mid-November will also see the TGA drawn down, unleashing a flood of cash back into the market, which will see bank reserve levels rise, alleviating the moderate funding stress. So the liquidity picture is set to change quite significantly over the coming weeks, potentially. This week into month end is probably as tight as the US-based liquidity gets until at least year end. Toward the end of November and to the end of QT, the end of QT on December 1st, liquidity becomes a tailwind and we really pump. These are the levels we should be buying Bitcoin position for the next leg higher, not financial advice, of course. Very well said, Post. Very interesting. And a lot of people are agreeing with the sentiment that we are just in a short term, or that this is the ebb, this is the lowest point of liquidity friction that we are going to experience. Whether we skyrocket from here or whether these funding stresses are even more important than we realize, we don't know yet. But we'll take a look at what some other people have to say after a quick word from our sponsor.
Looking for a prop firm that actually plays nice with automation? Meet Blue Sky, built for serious traders. And with TradersPost, it just clicks. You connect Blue Sky inside TradersPost, route your TradingView signals to paper or funded accounts, and let it auto-manage entries, stops, and targets. You control risk per trade, filter by session and symbol, and pause or resume with a single switch. Every fill is easy to review in one dashboard. Funded accounts can request payouts daily with launch plans starting at $49. Get funded with Blue Sky. Execute with TradersPost. Apply today at bluesky.pro, BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
All right. So we had the whole resolution between, well, almost resolution between U.S. and China and the whole trade war. We had and I quote from Donald Trump, who was asked about how well did the meeting with him and President Xi Jinping go this week. He said it was a 12 on 10. 12 on 10. It was great. No meeting could have been better. Well, let's see what he has, the breakdown of what actually happened. So we have the President Trump announcing the tariff reductions after amazing meeting with President Xi, including reduced fentanyl tariffs to 10% effective immediately. Overall tariffs on China reduced from 57% to 47%. China to discuss chip restrictions with NVIDIA. No more obstacles on rare earths, and China and U.S. to collaborate on Ukraine and trade deal appears to be coming next. And so they've been, Scott Bessent and Donald Trump have been going around just speaking very good things about China, very good things about the deal, and essentially trying to get the market to go back up, right? Because the market sort of went down as soon as there was good news about this, something that Donald Trump has lamented. So if there's a seldom news event that can always happen. There's a seldom news thing that happens, but we wonder if the what's actually going on. What do the commentariat in the FinTwit space think about what's going on with markets? So let's take a quick look at what Joseph Wang and Lynn Alden have to say before we wrap up for the day. This clip is from between Joseph Wang and Jack Farley talking about macro markets.
I think you said the Federal Reserve is going to start expanding its balance sheet.
My guess is that they will have to. Otherwise, they'll lose control over the repo market, and they don't want that to happen. I think what they misunderstand is that repo rates rise not because reserves are scarce, but because you have a tremendous fiscal deficit that's financed in repo. And without paying attention to the demand side of that, you are going to be misled and end up in a situation where repo rates do once again spike like they did in 2019, where you have to just keep adding. Otherwise, you'll lose control over short-term interest rates. It is absolutely essential for a central bank to be able to control short-term interest rates.
All right. So this is speaking to this idea that the Fed, because the SRF is being used so much right now, that the borrowing that the financial institutions and companies are doing at the Fed in order to get liquidity is not optional, but mandatory, that they need this money. And that begs the question, should the Fed continue to supply funds to these entities, or should they stop? Because it's not necessarily healthy as they become more and more dependent on this. And as Joseph Wang is saying over here, it's like, well, if they don't provide that liquidity, they don't provide that money, well, then they're going to get the volatility and the market sell-offs and the problems in the bond markets that they're trying to avoid. So they're almost, as some people have said, stuck in a permanent state of providing liquidity. How far that can go, who knows? I would have expected it to go so far as it did since the global financial crisis, and the stock markets have gone up and to the right. So who knows? They could continue to print money, continue to come up with ways of providing liquidity to market participants. But one thing's for sure: if they do not provide this liquidity and the funding stresses increase, well, then they're going to lose control over the interest rates, and that's not good. That could be bad. That's high volatility. All right, the last one of the play here comes from Lynn Alden. One moment. Who will speak about the difference of the quantitative easing and quantitative tightening. So a lot of people are jubilant right now, thinking that, hey, with the Fed cutting rates, we're in a rate cutting cycle. It means the money printer will turn on and a ton of money will flood into the system right away. But that might not be the case. So we have to think about this a little bit differently.
Basically, we're getting increasing signs of liquidity strain. It used to happen a couple times at the end of a quarter for window dressing. Now it's happening mid-quarter, which is why this time's different than prior months. The Fed is likely going to end quantitative tightening soon. It could be at this upcoming meeting. We don't know yet. They have some flexibility for when they do it, but it's likely going to be somewhat soon. And then in the coming months, they're likely going to go back to mild balance sheet increases. Now, probably on Twitter X, you'll see people saying, oh, we're going to hyperinflate, or oh,
QE is here, QE infinity.
Banks are failing, or this is happening. I'm in the camp that it'll be a relatively slow balance sheet increase. Now, maybe down the line, we have another crisis and it ramps up again, but this particular phase, we're exiting a period of slow balance sheet reduction, perhaps entering a period of flatness for a little while, and then most likely entering a period of gradual growth. The New York Fed has been putting out papers for years forecasting this. They forecasted that by 2025, 2026, the balance sheet reduction will end, and then they'll go to a period of balance sheet increases in line with GDP, so you get a pretty flat share of GDP balance sheet increase. And then also specifically, they expected that they would continue to reduce mortgage-backed securities by letting them mature off the balance sheet, but they would resume treasury purchases. And then over time, a larger share of their balance sheet would tilt toward treasuries, even as the overall pie is growing. And that is my base case. I think that they did forecast that pretty well. They roughly know where their boundaries are. They have clues when they start to get closer. Like you start to see usage of the repo facility, you start to see spikes in collateralized lending rates. And that's when they know that their estimates are becoming reality. And I think we're going to enter a period of persistent but mild balance sheet growth. And that it is pro-liquidity, but it's just one factor among many in markets to consider.
That means Lynn Alden is not seeing a printer go burr situation with the Fed. What she's seeing is far more of a slow increase of the balance sheet over months and quarters. What that means for assets, we have yet to know. Will the markets like it? We don't know. What we can definitely say is that if there's a huge shock and there's a drop, the Fed will come in order to help, whether in the bond market or the stock market. And we also know that if the market does not go up, well, we suspect that the market does not go up as fast as the Trump administration wants it to go up, well, then they'll take drastic measures in order to make sure that this does happen. That's it for After Hours today for October 31st. We'll be back next Friday for even more market commentary at 4 p.m. Eastern Standard Time. In the meantime, you can always feel free to like and subscribe on the channel, because every day we have content on TradersPost in order to try to make you a better trader, expose you to new strategies, expose you to new ways of seeing things and making money. We have Blueprint that happens on Thursdays at 3 p.m. where we talk about automation tools and scripts and indicators that we make for you for free. We're here on Tuesdays for office hours at 3 p.m. where we talk about, in general, how to be a trader and what features the TradersPost platform has in order to help you do so. And of course, Price Action Live that happens Tuesdays to Fridays, 9:30 a.m. Eastern Standard Time, where we trade live in front of you with live capital or prop firm accounts to show you the awesome power of the most advanced trade execution engine known to man, which is TradersPost. But until then, we wish you a happy Halloween weekend, a spooky weekend, and of course, happy trading. Bye, everyone. And bye, Ventura. Have a great weekend.